Welcome to the deep dive. Today, we're cutting straight to the chase. Okta's Q2 FY26 earnings. We're looking at the numbers, sure, but also what their guidance tells us, our goal. To figure out if Okta can really be that foundational identity layer, especially with AI and the big tech players looming, let's find out.
Yeah, and it's a crucial question. Okta isn't just another software company. They're pretty critical. People call them the world's identity company for a reason. They secure the digital identities that businesses rely on. So looking at their performance really gives you a pulse check on digital trust overall.
Okay, so the world's identity company, what does that actually mean for a business day to day? It sounds like they're the bedrock for, well, connecting users and tech securely, right?
Yeah,
Every login, every permission.
exactly. And it's broader than many people think. It's not just employees logging in anymore. We're talking non-human identities now, too. Things like device identities, service accounts, VMs, OA youth tokens. And this is interesting, even emerging AI agents. Identity is becoming their first line of defense, how they access data.
Wow, AI agents too. That makes it a C-suite issue, doesn't it? Not just IT. I mean, the CEO needs it for agility, the CFO for growth and cost management, and definitely the CIO or CISO for trust, security, privacy. It's like the plumbing that makes everything else work securely.
Precisely. It underpins so much.
Okay, so with that context, let's get into the actual Q2 numbers. How did they perform?
All right, the top line first. Total revenue hit $728 million. That's up a solid 13% year over year. And what really stands out is the subscription revenue. $711 million of that total. That's up 12% year over year. And it makes up like 98% of their total revenue.
98%, so it's almost entirely recurring.
Exactly. It shows how embedded they are. Once you're in with Okta, switching is really complex, really costly. That's a big advantage. Oh, and international revenue grew too, about 9%. It's now 20% of their total. So still expanding globally.
And thinking about future revenue, that RPO number, remaining performance obligations, is usually a good indicator, right?
Absolutely. It's their total subscription backlog.
It jumped 18% to over $4 billion. That seems like a strong commitment from customers, especially with the 2.5-year average contract length. What's your read on that?
That 18% jump to $4.152 billion. Yeah, it tells you customers are signing multi-year deals. They're not just testing the waters, they're committed. It really signals deep integration and trust in the platform, provides a very solid base for future revenue. And the current RPO, the part they expect to recognize in the next 12 months, that hit $2.265 billion.
Okay.
That's up 13% year over year. It's a really strong leading indicator for near-term performance. Gives good visibility into the next year.
Got it. So good top-line growth, strong future visibility. What about profitability and cash flow? That's been a focus area.
Definitely. And they showed real improvement there. Non-GAAP operating income was $202 million. That's a 28% operating margin.
Which is up quite a bit from last year, right? I think it was 23%.
Exactly. Up from $148 million, 23% margin last year. They actually said profitability was better than expected, attributed it to hitting revenue targets and being efficient with spending.
And free cash flow.
Nearly doubled. $162 million, which is a 22% margin. Last year it was $78 million, only 12% margin. That boost came from better operating profit and, importantly, strong collections. Always good to see.
Right. And that ties into the Rule of 40 metric that SaaS investors watch. How did they do there?
They hit 43%. So just as a reminder for listeners, that's revenue growth rate plus free cash flow margin. Hitting over 40%, especially at their scale, hitting 42%, shows a really good balance between growth and profitability.
So they're not just growing, they're growing efficiently.
Precisely. Disciplined execution on both sides.
Okay, let's talk customers, particularly the bigger ones. How's that looking?
That's another strong point. Customers spending over $100,000 a year with them, that base grew 7% year over year. There are 4,945 of those customers now. And importantly, these customers make up over 80% of their total annual contract value, or ACV.
Wow, 80%. And they added quite a few in the quarter.
Yeah, added 75 net new $100 K plus customers in Q2. And even higher up, the customers spending over $1 million ACV, that segment grew 15%. They have 495 of those now, and they represent over $1 billion in total ACV.
So it's not just new logos, it's existing big customers spending more.
Exactly. It shows the platform's sticky, and they're successfully expanding usage within those large enterprises.
Interesting. Now, looking at where that ACV comes from, workforce versus customer identity, workforce is still bigger.
Yeah, workforce identity that's managing employee access accounts for 59% of ACV, grew 10%. Customer identity managing external users for apps and services is 41%. but it grew faster at 15%.
And they expect that to move towards 50-50 over time. What's the strategy there?
Moving towards 50-50 is pretty strategic. Customer identity is a huge, fast-growing market. It lets them tap into consumer-facing apps, B2B portals, a much broader ecosystem. Diversifies revenue, integrates them deeper into customer experiences. It's a big growth lever.
Makes sense. Now, their dollar-based net retention rate was 106%. Solid. But they did mention macro-related pressures. What does that usually mean in practice for a company like Okta?
Yeah, micro pressures usually means things like economic uncertainty, making businesses a bit more cautious. So maybe they slow down expanding licenses, delay some projects, or if they have layoffs, that naturally reduces seats. For Okta, it suggests that even though their service is essential, they're not totally immune to budget tightening. They need to keep proving their value.
Okay, that makes sense. Given those pressures, how's their actual financial foundation? Do they have the resources to weather storms?
Oh yeah, their balance sheet looks very strong. They got $2.858 billion in cash, cash equivalents, and short-term investments.
That's a good cushion.
Definitely. Gives them a lot of flexibility for M&A, R&D, or just navigating uncertainty. They're also managing their convertible debt, looks like about $510 million due in 2025 and $350 million in 2026 remaining. So yeah, very solid financial position overall. No major strains there.
Good to know. So strong financials, but what's the underlying strategy? The CEO, Todd McKinnon, talks about their unified identity platform winning customers.
Right, and a key part of his message, something that really resonates, is Okta's independence and neutrality. In this age of AI, companies are using tech from lots of different vendors, different clouds, different AI tools. Being vendor agnostic, not tied to one specific ecosystem like, say, Microsoft or Google, is a huge advantage. It gives companies freedom and avoids lock-in.
Independence and neutrality. That sounds good, but does it really pull customers away from, say, Microsoft if they're already deep in that ecosystem? How's Okta prioritizing to make that happen?
Well, it seems to be working, and it's reflected in their FY26 priorities. Three main things. First, pushing the industry on security with their Okta Secure Identity Commitment, OSIC, showing leadership there. Second, winning IT and security decision-makers with a core Okta platform. And third, specifically winning developers with their more developer-centric offering, so targeting key buyer personas.
Okay, so a focused approach.
And they see a huge market to go after an $80 billion total addressable market, or TAM. They're not banking on just one thing. They've got multiple growth drivers.
Right.
Platform innovation, international expansion, partners, and landing bigger deals in large enterprises.
Right, the classic land and expand model.
Exactly. It diversifies how they grow.
Okay, so we've got the numbers, the strategy, but let's talk competition. What really gives Okta an edge, especially against a giant like Microsoft that bundles identity with everything else?
This is where it gets really interesting. And yeah, it goes beyond just features. First, look at what independent analysts say. Gartner, for instance. In their 2024 Critical Capabilities Report for Access Management, Okta scored higher than Microsoft in every single use case.
Every single one.
Every single one. And it's not new. This is the 8th year in a row. Okta's been a leader in Gartner's Magic Quadrant for Access Management. That consistency matters to enterprises.
Okay, analyst rankings are one thing, but reliability, that seems absolutely critical for identity. How do they stack up there?
It's a massive difference. From 2021 to 2024, Okta reported just 69 minutes of outages.
69 minutes over 3 years.
Okay. Compare that to Microsoft, over 2,100 minutes in the same period.
Wow, 2,100 minutes. That's, what, 35 hours? The cost of that downtime for a big company must be astronomical.
Exactly. Think about thousands of employees unable to work, sales missed, IT scrambling. It runs into millions very quickly, easily, plus reputational damage. And so far in 2025, Okta's had 0 global outages, meant they're 100% LA. That kind of reliability is a huge selling point. It's about business continuity.
It really is. Beyond just being up, what about security features and integrations? You mentioned MFA adoption was higher with Okta admins.
Yeah, over 90% MFA adoption for admins even before it was mandated versus Microsoft's 34%. That shows a stronger default security posture or maybe easier implementation. But also their integrations tend to be deeper. Things like provisioning users across tons of apps automatically, managing entitlements, what users can do, and universal logout.
Universal logout sounds important. Logout once, logout everywhere.
Crucial for security. And they have enhanced disaster recovery, cutting failover time way down. These are the kinds of things large, complex organizations really need, and where Okta often outshines more bundled solutions.
Can you give an example of where this makes a real difference?
Sure. Take News Corp. Global company, lots of M&A. They said using Okta saved them thousands of hours during M&A integration. compared to using Microsoft tools,
No.
just streamlining that complex process.
That's a tangible saving.
Or there's a robotics company, they completely ripped out Microsoft Identity and went all in with Okta for employees and partners. Cited flexibility, scalability, security. It enabled their whole ecosystem.
Compelling examples. All right, let's pivot to the future. What's their guidance look like for Q3?
Okay, for Q3 FY26, they're expecting total revenue between $728 million and $730 million. It's about 9% to 10% year-over-year growth.
Steady growth.
Yeah. Current RPO projected between $2.260 billion and $2.265 billion, also up 10% year-over-year. Non-GAAP operating income forecast is $160 to $162 million, which is a 22% margin.
Still quite profitable.
Exactly. And non-GAAP EPS expected around $74 to $74.75. So overall, a picture of continued steady, profitable growth in Q3. No big surprises, just solid execution.
And for the full year, fiscal 2026, did they update that?
They did. They bumped up expectations slightly. Total revenue now forecast between $2.875 billion and $2.885 billion. That's 10% to 11% growth for the year.
Okay.
But here's what's really notable. They raised their non-GAAP operating income outlook quite a bit. Now expect $730 million to $740 million. That implies a 25% to 26% operating margin for the full year. That's a strong signal of confidence in their efficiency.
And earnings for sure.
Also raised, now expected between $3.33 and $3.38 per share. And maybe most importantly, they raised their free cash flow margin outlook too, now targeting approximately 28% for the full year.
Raising profitability and cash flow guidance is definitely a positive sign. They mentioned the Axiom Security acquisition won't impact these numbers.
I expect it to be immaterial to guidance, pretty typical for these smaller tuck-in acquisitions.
And they said they're taking a prudent approach to guidance. What does that signal to you?
Usually, prudent approach means they're being conservative. They're likely factoring in potential economic headwinds, trying not to get ahead of themselves. It suggests they aim to meet or beat their own guidance, which builds credibility. It signals responsible management in a tricky environment.
Okay, so summing it all up, what does this deep dive tell us, and why should you, our listener, care about Okta? It seems clear they're financially solid, they have a clear strategy, and they're competing effectively in a really critical market, right? They're showing consistent results and improving profitability.
Absolutely. And the reason it matters to you is because digital identity is everywhere. It's fundamental to how we work, shop, connect online. Understanding a leader like Okta gives you insight into the plumbing of the digital world, how it's secured, how it functions, and maybe where it's heading. Their success or challenges reflects broader trends in digital trust.
Right. And that brings us to a final thought. As AI keeps evolving, integrating deeper into everything we do, what are the next big identity challenges? Where does identity become even more critical? Maybe not just for locking things down, but for enabling new kinds of innovation, something to think about.